Hello, everyone, and welcome to this lecture series from Chapter 7, Accounting for Receivables, and specifically this lecture series is going to be about bad debt. We are going to talk in this video, because this is going to be in parts. In this part 1, we're going to talk about what is bad debt, and we're going to learn about two different methods for accounting for bad debt. One is the direct write-off method, and it is not the preferred method, and we'll talk about why it's not preferred and what's wrong with it. And then we're going to learn about a better method called the allowance method, and we're going to talk about why it's better, and specifically the financial statement impact that the allowance method has, how the balance sheet follows the conservatism principle, and the income statement follows the matching principle, which the direct write-off method does not. So, first of all, before we get into bad debt, first let's take a step back and review what is accounts receivable. Well, accounts receivable is a promise that a customer will pay you cash in the future. Okay, you sell them something, they don't give you cash right away, they'll say, I'll pay you in 30 days, or however long you guys agree on. And that accounts receivable, is considered an asset because it brings future benefit because we're getting future cash. But the problem is that we don't always get future cash, okay? Some accounts receivable are what we call not collectible, meaning the customer has made a promise, like this IOU here, but when it's time to pay on that promise, they look in their wallet or they look in their bank account and they're like, sorry, I don't have the money to pay you. So that means the accounts receivable are not collectible, and we refer to that in accounting as bad debt. Okay. Now, there are a lot of reasons for why AR might be uncollectible. Like, I don't think people legitimately try to buy stuff and go, oh, I'm just not going to pay, haha. Nobody, I don't think, really does that. It's more just like business circumstances. So a company, so remember, with AR, it's business to business. Okay, so one company is selling to another company. And that company, they may not be doing so great. Maybe they have, their sales are declining and they just don't have enough money to pay, and they bought stuff thinking things were going to get better and then they just didn't. Or maybe they're, about to face bankruptcy. Like, bad circumstances have happened and now they just don't have the cash to pay their debts. It's not anything intentional. It just happens, unfortunately. So knowing that there's a risk that this would happen, that some of your customers may not be able to pay you, why would a company even take that risk? Okay, well, here's the thing. Credit sales, which means selling something to a customer on credit or on account, meaning they don't have to pay cash right away, they'll pay it in the future, that makes it easier for customers to buy. Okay, if you require that they have cash right at that moment they want to buy stuff, some of your customers just aren't going to have the cash at that time, and then they would have to be turned away, and you would lose out on that sale. You'd lose out on that revenue. So by making it easier for your customers to buy stuff, they're going to buy more, and that increases your revenue. So the hope is that the increase in revenue from allowing credit sales, knowing that most customers will pay, outweighs the chance that some customers won't pay, or outweighs the risk of bad debt. So the risk is smaller compared to the benefit of the increased revenue. Now, you notice here that I say that bad debt is an expense, okay? And it's an expense because it is the cost associated with generating revenue, right? We talked about expenses, goods and services used up to generate revenue. And that's kind of what happened here, was we had to use this risk, take that risk in order to generate this revenue. So that was a cost the cost associated with generating this revenue. So the question then is, if accounts receivable are not collectible, are they still considered an asset? Is there still future benefit there? And I think we can all agree the answer is no, right? If you're not going to get the cash, there is no future benefit. So if there's no future benefit, that means you have to remove that asset from your books or from your accounting records. And we refer to that as a write-off, okay? It means taking the accounts receivable off of your accounting records, removing them from your records. And what happens is the company does this write-off of accounts receivable when they give up on collecting it. Okay? So here's what happens. If you sell something to a customer, they say, I'll pay you in 30 days. You let those 30 days go by, and then if they haven't paid, you want to follow up, right? So just like if somebody owed you money, you would follow up with them after a while, right? So you email them or you call them and say, hey, what's going on? I haven't gotten your payment yet. And they go, oh, yeah, no, I never got the bill. Can you send that again? So you send it again, and they still don't pay after a week. You call them again. And they're, oh, yeah, I'm sorry, but I had to do payroll this week. I just don't have the cash right now. I'll pay you next week. Okay, and the next week rolls around, and you call them again, and they push you off again, and you keep calling, and they push you off and call you and push you off. And you're just like, they keep saying next week, next month, and you just never get the payment. Okay, and then maybe after a while, you call and they just ghost you. Like they don't even bother to pick up the phone or to answer the email to respond. They just flat out like disappear. You're like, what the heck happened? Okay, like they're not even talking to me anymore. Yeah, this happens. Like they just won't pick up the phone because they're afraid someone's going to call and ask for money. I've had clients do this, by the way. And then when it gets to that point where they just ghost you, maybe you're like, well, should I try more extreme measures? Should I get a collection agency involved to collect for me? Should I hire an attorney? Should I sue them to try to get my money? This process, before you give up, it takes a while, right? You want to try all of your different avenues before you actually give up on collecting. Okay, so when we say write off, right, that means, okay, we have an asset sitting here in our accounts receivable as a debit balance. We want to take it off of our books. So how do we take it off of our books? With a credit now to accounts receivable. So you've got the debit sale, then we'd have the credit write-off. So that shows now that it's gone, okay? That receivable, that future benefit is no longer there, okay? So there are two methods for accounting for bad debt. Okay, one method is the direct write-off method, and that method says the expense for bad debt is recorded when an account is written off or when we give up. Okay? So, like we said, the write-off is taking it out of accounts receivable or removing the asset. So we remove an asset or decrease an asset with a credit. If you go back to your debit credit rules, right? Our asset is going down, which is a credit of $1,000. But the other side of our entry under the direct write-off method is bad debt expense. Okay, we record the expense when we do the write-off. So you've got your expense and we've got the debit there of $1,000, bad debt expense. Okay? But the problem with doing it that way is, remember, I told you guys that this process of collecting can take a while, okay? The phone calls, it can go weeks, months, even years for some people. And different companies are going to have different policies for how long they're willing to try until they give up. Okay, maybe it's a set, I'm going to try for 6 months. I'm going to try for a year, whatever it is. Some are never, ever going to give up. And sometimes it depends. Sometimes it has to do with your relationship with the client or the customer. Sometimes it has to do with the dollar amount, right? If it's a small dollar amount, I'll try for a couple months and then give up. If it's a big dollar amount, I'll try for longer. But every company is going to set up their own policy. So what happens is this. Let's say this particular company, they make the sale in 2013, so it's $1,000 that happened in 2013. They wait 4 years before they write it off, and then in 2017, they go ahead and write off that $1,000. So let's see what that impact has on our financial statements. Okay, we've got our balance sheet in 2013 that shows this asset of $1,000, showing we're going to get a future benefit. But remember, in 2013, we started the process of calling them and emailing them and trying to get a hold of them, and they kept pushing us off, pushing us off, pushing us off. Well, we knew in 2013 that there might not be a future benefit, but we still, on our balance sheet for 2013, show that $1,000 there. So that, to me, says that our balance sheet is overly optimistic. It's showing an unrealistic picture of our future benefit. And that continues 2013, 2014, 2015, 2016. For 4 years, we show this future benefit. It's not until 2017 that we finally show, look, we're not going to get this money. Okay? Even though we've known it was doubtful for many years, we don't actually show that on our balance sheet until 2017. Then let's look at our income statement. Okay? We've got our revenue from the sale that happened in 2013, but the expense, the bad debt expense, doesn't show up on our income statement until 2017. But remember, the risk or expense was something that we took on in order to even generate this sale in the first place. If we hadn't allowed a credit sale in the first place, they probably wouldn't have bought anything from us. So what's happening is our revenue is in a different period than the expense associated with that revenue. Okay, so our income statement is not matching. It's violating the matching principle because revenue and expenses are happening in 2 different accounting periods. So we have some problems with our financial statements under the direct write-off method. So that's why the direct write-off method is not preferred under GAAP. GAAP is generally accepted accounting principles. It is not the preferred method. Instead, we want to use the allowance method. And what the allowance method says is this: every company must estimate their bad debt and record bad debt expense every accounting period, even if you don't want to give up yet. Okay, I know different companies are going to have different policies for when they give up, and some will never ever give up. But it doesn't matter. Even if you never ever give up, you still have to estimate bad debt and record that expense every single accounting period. And, it's not an exact science. We don't know for sure. It's an estimate. That's why I've got the guy here with his crystal ball. He's looking into the future going, God, what hints do I have? What do I know about this customer? What do I know about how their business is doing and how they've been paying me that I can tell? I can make an estimate of if they're going to pay or not. Okay? And the goal of the allowance method, by requiring every single company to do this every single year to record the expense, regardless of their different policies for when they're going to give up or write off, this causes us to have more reliable, more comparable financial information for investors and creditors. So let me show you kind of what the financial statements look like under the allowance method. Okay, so again, it's the same thing. The sale happened in 2013, the write-off in 2017. But what happens under the allowance method is your balance sheet starting in 2013 already shows 0. Okay, it shows, look, I don't think there's a future benefit there because we've tried calling. They haven't paid. I don't think it's there. The income statement also now matches the revenue and with the expense because we have to record the expense every single accounting period. So I'm going to match my revenues with my expense. So in this way, our balance sheet follows the conservatism principle, because we're showing a more conservative estimate, not overly optimistic, but we know, look, we're taking caution here because I don't think we're going to collect this, so we're showing a conservative asset, not overly optimistic, and our income statement is showing the matching principle because our revenues and expenses are matching. Now, how do we do this? I'm going to show you that in the next video. But I want you to make sure to do a concept review on all of these concepts that we discussed in this video. What is AR? What type of account is it? What is bad debt? What type of account is it? Why do we risk bad debt? What is a write-off? What is the direct write-off method and what's wrong with it? What is the allowance method? Why is it preferable for both our balance sheet and income statement? So make sure you understand those concepts before we move on to the next. See you next time.